The Chinese tax authorities have implemented a 20% levy on offshore trust structures, creating immediate pressure on wealthy mainland investors to recalculate their liabilities and restructure holdings. Welcome to another episode of Regtalks. Join us as we explore how the new rules mark a significant escalation in China's campaign against capital outflows and untaxed foreign income.
It's pretty intense. I'm glad we're tackling this today. We'll break down the fresh tax rules, explore their ripple effects, and share what this means for wealthy mainland investors.
Listeners, expect an inside look at the tax changes, how enforcement is expanding, why compliance might trigger asset investigations, and the sheer scope of offshore holdings at risk.
We'll also touch on how these policies operate in practice, plus what ultra-high net worth families should be planning for right now.
Let's dive straight into the nuts and bolts. The new rule, a flat 20% tax hits offshore trust structures both when assets go in and on the yearly income those trusts generate.
The timing couldn't be tighter. Tax authorities in Beijing and Hangzhou are demanding that unpaid taxes on assets placed in trusts since January 2023 and income earned before 2026 be reported within just 90 days.
That's a real scramble for investors. We're talking hundreds of billions managed in family trusts, most overseen through Hong Kong or Singapore low-tax havens that now aren't so safe anymore.
Consulting group estimates that ultra-high net worth individuals in China channel about $1.2 trillion offshore. This means the new tax is hitting a massive pool of capital almost overnight.
But the crackdown doesn't stop at trusts or insurance policies. Bank of America's analysts warn enforcement could soon reach overseas employment income and even gains from offshore securities trading.
That part really caught my eye. China's tax authorities are saying all residents' overseas income must be declared and taxed, regardless of the type. That's a sweeping statement.
It's more than just words. With the Common Reporting Standard in place since 2017 and the Golden Tax Phase 4 system, authorities can now cross-check financial information across jurisdictions.
So, anyone assuming their assets were invisible just got a wake-up call. This isn't just about trusts anymore. It's a whole new risk landscape for offshore wealth.
Funny you mention risks. What worries wealth advisors most isn't the tax bill itself, it's whether strict compliance opens the door to capital controls investigations.
Absolutely. Once wealthy investors start reporting their offshore assets, authorities might dig into how those assets left China in the first place. That can be a can of worms.
It's a tension, comply fully and risk scrutiny, or try to stay under the radar and risk penalties. There's a sense that tax compliance could become a trigger for more serious asset probes.
And with China's property downturn fueling fiscal pressures, officials are under even more incentive to recover lost revenue wherever they can.
Let's unpack announcement number 21 from July 2026. That's when China's Ministry of Finance and State Administration of Taxation stepped up collection on undeclared overseas income and capital gains.
The timing is critical. With the real estate slump dragging on and government revenue in the spotlight, ultra-high net worth individuals became an obvious target for tax authorities.
More than half of China's super rich rely on offshore trusts for wealth management. Now, the announcement effectively shines a light on hundreds of billions, making secrecy much harder.
Wealthy families are facing tough choices. Disclose and pay up, restructure assets, or risk falling foul of rapidly tightening rules. The pressure is real and growing fast.
To wrap up, here are three big takeaways. First, China's new 20% offshore trust tax is shaking up wealth management for its richest residents. Second, enforcement is spreading to other overseas income, powered by tighter reporting standards. Third, tax compliance could open doors to deeper asset scrutiny and capital controls.
If you're advising wealthy clients or managing assets, the next step is to audit all offshore holdings, urgently calculate exposure, review reporting obligations, and start restructuring where needed.
Thanks for joining us. Keep a close eye on these evolving rules, and tune in next time for more insights on global finance shifts.
Let's stay informed and proactive. These regulatory changes are just getting started.